Hey everyone, welcome back to Dividend Talk. Today I wanted to dive into one of the most recognisable real estate investment trusts, Realty Income, ticker symbol O. And the reason for that is, in my portfolio, Agree Realty became my top 3 position because its share price really increased over the last couple of months. But however, when I look at Realty Income, it just hasn't increased the same way. And I'm wondering why. So today I want to dive into this company and have a little look at why I think the share price has not performed as well as Agree Realty and whether or not they present a good buying opportunity. So before we start, let's have a quick look at what Realty Income actually do. Let's be honest, they're famous because they are known as the monthly dividend company. Now, calling yourself the monthly dividend company means that you get consistent dividends every single month. And for the last 109 quarters, they have increased that dividend, which gave them an annual compound growth rate of around 4.2% since 1994. And that's actually quite impressive, especially when you think about their yield, which currently sits above 5%. But even though the company has paid 652 consecutive monthly dividends, they have to earn money to do this. Now, they have a strong portfolio of over 15,000 properties, and that covers all 50 US states. They have properties in the UK and also 6 other countries in Europe. Approximately 98% of their portfolio is made up of single tenant properties, and this is predominantly with triple net lease agreements. Now, triple net lease just means that the tenant is responsible to pay for some property taxes, insurance, maintenance, and even utilities. What this does for Realty Income is that it gives them a steady stream of income, especially with long-term occupancy rates, which averages at around 9.4 years in their current portfolio. It lowers management's responsibilities as tenants handle the property upkeep, but the risks with that is that it can limit upside potential due to the earnings cap in these lease agreements. Now, looking at the map of where all the properties are, you can see it's predominantly in the United States, which you would expect, and actually more so on the east side of the United States. But there is a growing presence within Europe, particularly in the UK, which have a strong presence with the likes of Sainsbury's and Tesco's. But they have expansions even into Ireland, into Portugal, Spain, Germany, France, and even Italy. So premium subscribers would have got my deep dive on Agree Realty. And one of the criticisms I have of Realty Income is that their portfolio of tenants is not as strong as Agree Realty's. Now, we look at some of these tenants like Walgreens, which we know are struggling, 7-Eleven can be struggling, but, and here's the big but, they don't make up a huge amount of the portfolio. You can see that the largest company on their books, which is Dollar General and Walgreens, both make up 3.3% of the total rent received. And actually, over 85% of reporting tenants have revenues greater than 100 million. So their tenants are not as bad as we make out. Yes, they are not as strong as Agree Realty, but the top 5 tenants only make up 14.3%. And that kind of diversification makes them a little bit more resilient, just in case the likes of Walgreens, who are struggling at the moment, underperform and have to sell some stores. But what is really interesting about Realty Income is how they have evolved over time. This was one of my biggest concerns about them a couple of years ago, particularly when they moved into gaming, because it wasn't inside of their circle of competence. But their entry into this sector began with acquisitions such as the Bellagio Hotel and Casino in Las Vegas. Everyone knows I love Las Vegas, so I thought this was a good idea, but again, it's just outside their circle of competence. As of Q3 2024, gaming properties accounted for 3.2% of Realty Income's total annualized contractual rent. So again, we have lots of diversification there. They've pivoted again and have started looking at data centers, particularly through a joint venture with Digital Realty. And this pretty much focuses on a project in Northern Virginia. So to be honest, while I did have concerns a couple of years ago, management do seem to be doing quite well in this regard. I do like how they are expanding into different sectors, and I also like that they're expanding into Europe with top quality companies such as Decathlon, Tesco and Sainsbury's. So in all honesty, that does sound great. We've got a good dividend history with a company that is expanding. It's seemingly growing both nationally and internationally, but yet the share price has not gone anywhere over the last few years. So let's check out and see why I think this is the case. One of the main reasons you will hear people say that the share price hasn't done so well is because of interest rates. And that's partly true, but remember, interest rates are the same for Agree Realty as well. Looking at this chart you can see in front of you, you can see that from 2016 to just around 2019, the start of 2019, we had a sharp increase. It then dropped off again, but look at that increase since 2022. So high interest rates, yes, are playing a part in the share price being low, but it's not telling you the whole story. So one of the biggest reasons for me that the share price is depressed is due to the weighted average shares outstanding. Now, if you look at the chart there in front of you, you can see that they have been adding shares quite aggressively since 2020. Now, if share buybacks help to increase shareholder value, then issuing shares has the opposite effect, and actually it decreases shareholder value. So the question is, why are they doing this? Well, I just took a snippet here from the 2023 annual report, and you can see that they are investing quite heavily. In 2023 alone, they invested 9.5 billion. Now, they have to raise that capital somehow. You can do it by issuing debt. However, in a high interest rate environment, this can actually be detrimental to the company as they are paying loans off at a higher interest rate. So one way around that is to actually dilute their shares. They have been adding debt, as we can see on this chart. They've added it quite significantly over the past 4 or 5 years, but it would have been a lot worse if they did not dilute their shares to help fund some of these investments. Now, as a shareholder, am I happy about them buying back, or actually not buying back shares? Am I happy that they are issuing shares? And the answer is not too disappointed, if I'm honest. And the reason being is they have still been able to grow their adjusted funds from operations while heavily diluting their shares. And that to me is actually quite impressive and shows how much growth they're actually having. If you look at 2013 to 2024, the average funds from operation growth is around 6.3%. Again, this is just another graph to show you how much adjusted funds from operation has been growing. And you can see in 2020, 2021, all the way up to 2024, we have seen really strong growth. And again, I have to say this is quite impressive considering the amount of shares they have issued over that period. So overall, I'm actually quite happy with Realty Income. Their expansion internationally is going quite well. I was a little bit worried, I have to say, in the beginning, but they are investing in good properties with good tenants such as Tesco's, Sainsbury's and Decathlon, as I have mentioned before. They have got a proven track record. We can see this 13.4% compounded annual total return since 1994. They are a dividend aristocrat and they increase their dividends quarterly. And the best part is all of this comes with a whopping 5.73% dividend yield. And honestly, I don't think there's much safer yields at those levels than with Realty Income. There are many different ways to judge this, but I'm going to use the NAV value. And to help me come up with these calculations, I actually have this book called Real Estate Investing, and I think it's a fantastic book, especially for beginners looking to invest in real estate. Now we have this NAV calculation up on the screen, which I have in a G sheet. It looks really complicated, but honestly, calculating the NAV value is as simple as getting the total assets minus the total liabilities and dividing it by shares outstanding. Now the NAV price that we got is $53. They're currently trading at around $56, so that would tell you that by this calculation they are slightly overvalued. But sometimes I feel like I can be penny wise, pound foolish. And really $3 is not a lot considering the yield that they're trading at, and if I intend to hold them over the next 10 to 20 years. I made this mistake before with Microsoft, but again, with a long time horizon, I actually think they're fairly valued at $56. So with that in mind, I will be adding to this position in the next couple of weeks. Well, I hope you like this little look at Realty Income. If you like these type of videos, please let me know in the comments below and I'll try to do more. And as always, please subscribe if you haven't. Also hit that like button. I would really, really appreciate it. See you next time.